Welcome to Breaking News to Trading Moves. This is where we take a look at a recent market event and trace where the capital is flowing because of it.
Today we're focused on a development in the energy sector. It's a really clean case study in market mechanics. Borr Drilling's announcement of a new public offering of its common shares.
Right, that's Borr Drilling, ticker BORR. They've decided to raise fresh capital by selling new shares on the market. So for you, our listener, our mission is to examine the fallout from that. Because an event like this, it's not isolated. It creates immediate movements. We want to identify which sectors and which specific companies are now in a good position to benefit and which ones might feel some pressure.
And the action itself is purely financial. They're raising funds to capitalize on expected demand down the line. But when a specialized, high-profile offshore driller like Borr does this, and does it successfully, it instantly validates the entire offshore thesis.
How so? What's the message?
It tells the market that management believes the multi-year drilling cycle is robust enough to justify, fleet expansion and new capital expenditure, or CapEx. And that immediately focuses investor expectations.
Okay, let's get into those focused areas. If the signal is confidence in offshore activity, that confidence and that capital won't just stay with Borr, it's going to flow out. So what's the first, most direct category of companies set to benefit?
You'd start with their direct peers, the offshore drilling and oilfield service providers.
Their peers.
Yes. When a key player like Borr makes a move this calculated, it reinforces the market's belief in a sustained, multi-year offshore drilling upcycle. The stronger contract outlook means renewed investor attention for the whole ecosystem.
Hold on, why would Transocean or Noble celebrate Borr raising money? Isn't Borr now just a better funded competitor? That feels a little counterintuitive.
It's a great question, and it's all about validating the macro environment. Yes, on a micro level, they are competitors. But a capital raise like this confirms to the market that the demand, meaning the oil and gas companies that need the rigs, is high enough for everyone to benefit.
Okay.
It's a tide that lifts all boats in that specific sector.
So the market reads this as confirmation that the overall pie is getting bigger, not just that Borr is getting a bigger slice of it.
Exactly right. Investor focus shifts pretty quickly to other firms with comparable, high-specification assets. We're talking about companies like Transocean, that's ticker RIG, and Noble Corporation, ticker NE.
Okay.
Borr's offering acts as proof of concept for the demand for these offshore rigs, which in turn makes their own assets more valuable.
Understood. Macro environment validated, peers get a boost. So let's follow the money mechanically. If Borr is raising cash to expand or modernize, well, they have to spend it somewhere. That brings us to the supply chain, right?
It does.
What's the second group that's essentially getting a direct deposit from this?
That takes us straight to the energy equipment manufacturers. I mean, you simply cannot increase offshore drilling without a proportional increase in demand for highly specialized, often custom-built equipment.
Right.
When drillers expand their fleets, they are basically generating massive purchase orders for these manufacturers.
So this is where we stop talking about balance sheets and start talking about, actual steel and complex engineering. What kind of parts are we looking at here?
We're talking about everything a modern rig needs to function. Think of the massive subsea systems that connect the rig to the seafloor, the essential blowout preventers that ensure safety, regulatory compliance, and all the advanced rig automation tools. These are big-ticket, high-margin items.
Okay, so when Borr gets the funds for CapEx, capital expenditure, the money for physical assets, it's these manufacturers who see their order books grow almost instantly.
The revenue pipeline grows, yes.
So if I'm looking for where that spending actually goes, who are the main recipients of those orders?
You'd look at the established major suppliers in this space. It's highly specialized. So firms like NOV Inc., ticker NOV, which is a massive manufacturer and supplier of this equipment, and also Baker Hughes, ticker BKKR.
Okay.
When the drillers raise capital, these suppliers are historically the first to benefit from that spending.
That's a clear flow. Capital raised, CapEx budgeted, purchase orders are cut. Got it. Now for our third group of winners, let's look at the infrastructure that's maybe a bit overlooked, but absolutely necessary.
You're talking about the marine and logistics support providers.
Exactly.
And this relationship is probably the most fundamental. When Borr and its peers put more rigs into service, the utilization rate for the entire offshore support network has to increase. This is that crucial sort of hidden infrastructure.
And how does that utilization rate specifically affect their bottom line?
It's all about day rates. The day rate is simply the daily price to rent a specialized piece of equipment, in this case, marine support vessels,
Yeah.
crew transfer ships, specialized subsea service contractors. When utilization rises, meaning most of those vessels are already contracted out, supply gets tight, and the cost to rent them, the day rate goes up, sometimes dramatically.
So their profitability goes up just because their assets are in higher demand. Simple supply and demand. Who are we talking about in this segment?
We have clear examples here. A company like SEACOR Marine, ticker SMHI, and also Oceaneering International, that's OII. They provide the highly specialized vessels and the subsea robotic services that are absolutely essential to keep offshore operations running.
Okay, so to quickly recap the upside. Borr's capital raise boosts confidence across the whole offshore vertical. It drives investor attention to its rivals, its equipment suppliers, and its logistics partners.
That's a good summary.
Now let's flip the coin. What segments feel the pressure from this same announcement?
Well, the scrutiny starts right away within the drilling sector itself. It brings everyone's balance sheet into focus. The first category to face some negative attention is what we call highly leveraged drilling firms.
But didn't we just say the whole sector is winning because of this cyclical optimism? Why is one firm's good news suddenly bad news for others in the same business?
Because Borr's successful public offering, the fact that it was well executed, it acts as a mirror for the market. It forces investors to immediately compare capital structures. When one of your peers raises capital cleanly, it instantly shines a spotlight on the existing debt and the balance sheet risks of companies that might not have the same access to cheap equity.
Ah, so it's not just about needing money, it's about the way you raise it. Borr just set a high bar for capital efficiency that maybe others can't clear as easily.
Precisely. These highly leveraged firms may face market pressure if investors start to anticipate that they'll need their own future capital raises, which could come at unfavorable terms. We call these dilutive offerings.
Meaning they issue so many new shares, it hurts the value for current investors.
Yes, and the market starts pricing in that future dilution risk for the players that look weaker.
So that creates a capital disadvantage purely based on perception. Who are some of the firms that might feel this pinch?
We'd probably place firms like Helmerich and Payne, ticker HP, and Patterson UTI Energy, ticker PTEN, in this category that's now under a microscope.
While they operate in slightly different parts of energy services, their financial structure is now being judged against the success of Borr's raise.
That makes perfect sense. Okay, moving on from financial structure, let's look back at the services space. Borr has fresh cash, which makes them a more formidable competitor for contracts. How does that affect the smaller players?
That brings us to our next group, small cap energy services firms. The issue here is really capital concentration.
What do you mean by that?
Well, when large institutional funds decide to pour money into the energy ecosystem, which they do after a positive signal like this Borr offering, they tend to favor scale and stability. They pool their money toward the larger, proven, and now newly capitalized players, like Borr.
So the capital doesn't really filter down evenly, concentrates right at the top, making the leaders even stronger. That's it, exactly. And this leaves the smaller service firms at a competitive disadvantage. They struggle to get the market's attention, and more critically, they might start to lose out on contract bids against these larger, better-funded competitors who can now bid more aggressively.
A classic case of the rich getting richer in terms of access to capital and contracts. Can you give us some examples of these smaller entities that might feel the squeeze?
Yeah. We are looking at specialized field operations firms like ProPetro, ticker PUMPE, and also Next-Tier Oilfield Solutions, ticker NEX. They now find themselves competing for business against newly emboldened giants.
Okay, now for the final category. This one is less obvious because it's outside the upstream world we've been in. Why would refiners and downstream companies feel pressure from an increase in offshore drilling confidence?
This is a forward-looking supply and demand mechanism at work. The market views Borr's capital raise as a firm indication that future crude oil supply from offshore sources is going to increase meaningfully in the coming years. Investors are reading the tea leaves.
So before a single extra barrel of oil is even pumped, just the expectation of more oil hits the market. What does that do to prices?
It applies a generalized downward pressure on the crude price curve, especially for longer-dated contracts. And while lower crude prices might sound good for consumers, they actually tend to compress refiner margins.
How does that work?
Well, refiners buy crude oil, that's their input, and they sell gasoline and diesel, their output. If the market expects cheaper crude in the future, it immediately puts pressure on the value of the crude they have already bought and are currently processing.
So their inventory value could drop, and their ability to profit from the spread between their input cost and their output price gets squeezed.
That's the key challenge. The expected long-term supply increase translates into immediate pressure on companies that rely heavily on those refining margins. This pressure lands on entities like Marathon Petroleum, ticker MPC, and Valero Energy, ticker VLO. They're on the downstream end of the energy stack that reacts negatively when the upstream succeeds like this.
That really paints a complete picture. So the Borr drilling capital raise, which on the surface is just one company's financial event, acts as a powerful signal of confidence in offshore expansion. It creates this upward demand for services and equipment across the whole upstream ecosystem.
And at the very same time, that same confidence introduces competitive pressure and capital scrutiny on leveraged peers, it disadvantages smaller service companies, and it simultaneously squeezes the margins of downstream processors like refiners, all due to that expectation of future supply. It's one event with remarkably divergent impacts.
So as you walk away from our discussion today, remember the speed of market perception. Based on the structure we've just laid out, where we see positive momentum for the upstream drillers and pressure for the downstream refiners, you should consider how rapidly investor attention in the oil sector can pivot. Specifically, think about how quickly the market can go from rewarding upstream producers to, well, potentially penalizing downstream consumers based purely on the promise of oil hitting the market years from now. That speed of perception is really something.
Please remember that the discussion presented here is purely the opinion of the author and is not financial advice or a recommendation to buy or sell any of these securities.
Thank you for joining us for this analysis of market flow. We'll see you next time on Breaking News to Trading Moves.